What does it take to pull off the greatest trade of all time? Today, we break down the biggest wins in market history. We start in 2000 with Sir John Templeton. At the peak of the dot-com bubble, tech stocks were priced for the moon. Templeton, who was already in his late 80s, took the contrarian view. He shorted a basket of 84 internet stocks with roughly $2 to $3 million in capital just weeks before the crash. By October 2002, the Nasdaq had fallen more than 75%. Templeton closed out early, banking around $80 million, a return of more than 2,500%. That same year, another skeptic, Jim Chanos, made his mark. From 2000 to 2001, he dug into Enron's shady accounting, off-balance sheet debt, and fake trades, and bet against the stock. Chanos' fund shorted about $60 to $70 million worth of Enron shares, and when Enron collapsed in December 2001, his short position paid off to the tune of about $500 million, an approximate 700% gain. Jump to October 1987, Black Monday. Paul Tudor Jones anticipated the crash months in advance. He shorted stock index futures with an allocation of about $100 million, then pivoted into bonds as equities collapsed on October 19th. His fund tripled that year, generating roughly 200% plus returns, with Jones personally making about $100 million. Then there's Jesse Livermore, the great bear of Wall Street. In 1929, he quietly built massive short positions totaling about $10 to $15 million just before the crash. When markets imploded in October, he made an estimated $100 million, over a 600% gain and worth more than $1 billion in today's dollars. Fast forward to the Great Recession. In early 2009, when everyone thought banks were finished, David Tepper saw something others didn't. He believed the U.S. government would never let the financial system fail. He loaded up with around $1 billion in capital into Citigroup and other battered financials for pennies. By the end of 2009, his fund was up 120%, pulling in around $7 billion in profit. Tepper himself pocketed $4 billion that year, but Warren Buffett was just as bold. In 2011, at the height of the U.S. debt ceiling crisis, he struck a $5 billion deal with Bank of America. Preferred stock paying 6% plus warrants to buy 700 million shares at just over $7 each. By 2017, those warrants turned into more than $20 billion in value, over a 300% return on his initial commitment. It became one of Buffett's single most profitable trades ever. Bill Ackman, meanwhile, pulled off one of the fastest trades in history. In February 2020, just as COVID was starting, he spent $27 million buying credit default swaps. By March, when markets crashed, those CDSS were worth $2.6 billion. That's nearly a 9,500% return in just weeks, one of the most jaw-dropping hedges ever. Of course, we can't forget George Soros. On September 16, 1992, Black Wednesday, Soros bet about $10 billion in leveraged short positions against the British pound, believing it was unsustainable inside the European exchange rate mechanism. When the UK government caved and devalued sterling, Soros's quantum fund walked away with a $1 billion profit in a single day, a 10% return on enormous size. Michael Burry was one of the earliest to spot the cracks in subprime mortgages. Back in 2005, while most of Wall Street was partying on the housing boom, Burry was combing through thousands of individual loan pools. He noticed a dangerous pattern. Tons of adjustable rate mortgages were set to reset, and when they did, defaults would soar. To bet against this ticking time bomb, he asked banks like Goldman Sachs and Deutsche Bank to create custom credit default swaps, CDS, tied to the worst subprime bond. He committed about $100 million in CDS premiums, but in 2007, when defaults spiked and the mortgage market collapsed, Scion Capital walked away with about $700 million in profits, and Burry personally made around $100 million, an approximate 600% return on capital deployed. John Paulson built the bonfire. Entering just a year later, in 2006 to 2007, Paulson launched the Paulson Credit Opportunities Fund and scaled the same idea to an almost unthinkable level. While Burry was managing hundreds of millions, Paulson went all in with about $500 million in CDS premiums against subprime bonds, tens of billions in notional exposure. When the housing bubble finally burst, the payoff was staggering. Paulson's funds pocketed an estimated $15 billion in profits, roughly a 3,000% return on capital deployed, with Paulson himself personally taking home nearly $4 billion in 2007 alone. What these trades teach us, from Soros breaking the pound to Paulson shorting subprime, every legendary trade had one thing in common: events. Crashes, policy shifts, restructurings, and crises created rare windows of opportunity. The traders who recognized those events and acted with conviction etched their names into market history. The lesson? You don't need to predict the future. You need to recognize when events are about to reshape the market or a company. That's exactly what Levelfield's AI is built to do. Like Buffett stepping in on Bank of America or Ackman hedging against COVID, Levelfield scans 30,000 plus filings, press releases, and market signals per minute to detect the catalysts that move stocks and options. The platform surfaces the same kinds of events that powered the greatest trades of all time. Now, you don't need billions to trade like Buffett. With Level Field's AI, you can follow the same event-driven catalysts that move markets. Activist stakes, CEO shakeups, buybacks, FDA approvals, and more. Follow and subscribe for more. Level Field's Elite Investing, effortless AI.